Hey, money viewers, it's me, Tiffany, the Budgetnista, your favorite financial educator. Let's talk funds, okay? To be specific, let's talk mutual funds, ETFs, and index funds. What do all that mean? What do they all mean? Let's start with mutual funds. A mutual fund is a basket of stocks and bonds and other securities that's put together and you buy it with other people. That's why they call it a mutual fund. Think about almost like a GoFundMe where you're like, you know what? Instead of buying these individual stocks and bonds that collectively we can actually buy more by buying these baskets together. Now, most mutual funds are actively managed, which just means that there's an actual person, not an algorithm, picking those different investments that are going into the basket. What makes mutual funds special, other than them being a basket, is that it does not trade on the market. Instead, you can buy after the market closes once daily. That's a mutual fund. Let's talk ETF. Exchange traded fund. So think of an ETF like the love child of a mutual fund and a stock, right? So ETFs are also this basket, but unlike mutual funds, most ETFs are passively managed, which means an algorithm is kind of picking out the investments that are in the basket. And ETFs can be traded just like stocks on the stock market. So during the day, you can literally buy and sell that ETF, unlike a mutual fund. Does that make sense? Good. Last but not least, let's talk index funds. So what is an index fund? An index fund is a fund that closely tracks markets. Like think of the S&P 500, the NASDAQ, the Dow Jones, right? What that means is depending on the index fund that you choose, it's supposed to basically do what that index does. So for example, the S&P 500. The S&P 500 tracks 500 large companies in the United States that are traded on the stock market, right? If you choose an S&P 500 index fund, whatever the S&P 500 is doing, that is what your index fund is supposed to do too. The difference between an index fund and a mutual fund is this. An index fund is meant to mirror the market. It's meant to do what the particular index in that market is doing. A mutual fund, because it is actively managed, is really meant to beat the market. That you're paying more, because when something is actively managed, oftentimes the expense ratio, which is the fee that you pay in order to be able to invest into that particular investment, that expense ratio is higher because that person is supposed to try to beat the market. So whenever a human being is involved, just know they want to get paid and expense ratios go up. So remember, index fund mirrors the market. Mutual fund typically is trying to beat the market. So I hope these funds make more sense to you.